Okay, well, let's go then. Welcome everyone to today's CDAR seminar, March 1st. We're delighted to have our friend and getting more and more familiar with his work, Alexander Braun from University of St. Gallen. He's coming to us from Switzerland today, so it's quite a treat, talking about common factors in the cross-section of catastrophe bond returns. So Alex, I'll put this over to you and just put myself on mute for now.
Perfect. Thank you very much for the introduction, Lisa, and thanks everyone for inviting me again. It's a pleasure to join the seminar the second time actually after last fall. And yeah, this time it's a different paper than last time. So this paper is about cat bonds, catastrophe bonds, which is an asset class that has been around for about 25 years, but really the market started growing significantly in the mid-2000s. And essentially it's a financial instrument that securitizes insurance risk, natural catastrophe risk or property catastrophe risk. So it's a fixed income instrument that includes an embedded reinsurance contract, an excess of loss reinsurance contract. And investors in these instruments put up capital as collateral for the potential occurrence of the insurance event, the underlying natural disaster, if you want. And in case that happens, there are different trigger mechanisms. Then investors could lose that capital because the capital will be paid out to the entity that is, as we call it, sponsoring the bond, or that is ceding the risk to the capital market. And in exchange for that potential loss that investors might suffer, they get compensated with a spread above a variable interest rate. So cat bonds are floating rate notes. They pay a floating interest rate on a regular basis. And then on top of that, you get a risk spread. And that coupon risk spread is based on the underlying natural catastrophe risk. And so what we are looking at in this paper is the cross-section of realized cat bond returns, which is something that has not been studied a lot so far. So just let me give you a little bit of a background with regard to why we think this topic is interesting and important. And I hope that you can agree with that. So this market for alternative reinsurance capital, that's a little bit broader than the pure cat bond market. So cat bonds have grown to about 35 billion as of today. In outstanding volume. So obviously compared to the equities and broader fixed income market, it's still small, but compared to the overall reinsurance market, it's becoming more and more significant, particularly if you add on top other types of so-called insurance-linked securities or alternative capital instruments. You get up to a size of about 100 billion. And it's been quite constant in the last 3 to 4 years. So it's been a little bit above and below 100 billion. A little bit of stagnation has been going on, but most experts agree it's going to increase further in the future. So with regard to the reinsurance market, it's actually a considerable size. It's about 20% of today's outstanding reinsurance capital. So a lot of that risk is already being ceded outside the classical insurance and reinsurance industry and it's going directly to the capital market. It has grown tremendously, particularly since 2006, but also in the last 4 to 5 years, we've seen double-digit growth rates, rapid growth in the market. The reason for that is twofold. On the one hand side, there's a lot of need to seed these types of risks, the underlying natural disaster risks, because the insurance and reinsurance sector is capacity constrained, and we've seen a lot of major disaster years, particularly 2017 with Harvey, Irma, and Maria in the US, and then also 2018 and 2019 with wildfires. So there is a need for additional reinsurance capital. The research in this area so far has focused on the determinants or the drivers of coupon spreads on cat bonds, and also on secondary market yields. So one interesting aspect about this instrument is that there is a secondary market with a decent liquidity. So there are trades happening And so you can not only observe prices and spreads at the time of issuance of the bonds, but you can also observe ongoing quotes and also traded prices in the secondary market. And so it's a little bit astonishing at first glance that there's not so much research that has actually looked at the realized excess returns, or for that matter, expected excess returns, which we'll do in this paper. But then upon second glance, one realizes that it's not so easy to get the data, right? Because this is an OTC market. And so one needs to work together with industry participants to try and gather data, which is what we did for this paper as well. And then sort of basically the last point that motivates the paper is in a 2019 paper, I have already looked at the NAV time series and the return time series of insurance-linked securities funds. So there are specialized investors out there that invest exclusively in this asset class. And we've tried to develop a factor model back then already that explains the fund time series, so the portfolio returns of those funds. And in the course of doing that, we found out that a whole range of classical factor models, such as the Fama-French models and others, really do not explain anything in this asset class, right? And that's the reason for that is relatively clear, because it's a truly alternative asset class in a sense that it is uncorrelated to the broader capital markets, because the risk that is underlying these instruments is a natural disaster risk and not a financial or macroeconomic risk. So what we do in this paper is we try to build a little bit upon that idea of creating a factor model for cat bonds that explains return and excess return differences in the cross-section of cat bonds based on bond characteristics. So the idea is not yet, so that'll be future research, but the idea is not yet to explain why cat bonds do, compared to other asset classes, pay these interesting and attractive returns. I have a slide on that in 1 or 2 minutes. The idea in this paper is really to, first of all, understand why cat bonds, depending on their characteristics, bond-specific characteristics, pay more than other bonds in terms of realized returns. So why do we think it's an interesting asset class to study? I've briefly mentioned a little bit about that already, but if you look at the historical performance, the black line is a cat bond index that we generated from our data set, but you can also look at the Aon. Aon is a large reinsurance broker. They create their own index, in Swiss Re, one of the largest reinsurance companies in the world, has an own performance index for cat bonds as well. And if you, they look pretty much the same, right? They're very highly correlated with our index. And if you look at the index, you see very little volatility, and you see very little correlation to other asset classes. And this has attracted substantial inflows into the asset class, particularly from pension funds. So a lot of long-term investors like pension funds have gotten, have basically started to pay attention to this asset class, because they, in the ongoing zero interest rate or low interest rate environment, they are on a quest for yield. And this asset class is really interesting because it pays attractive returns, and it is really a diversifying element in your overall portfolio, because as you can see, the correlations with these other asset classes, such as corporate bonds or the stock market, if you want, is very low. So it is.
Alex,
yeah.
Sorry to interrupt. This looks like what we call a Bernie Madoff curve.
Yeah. Yes.
Does it seem too good to be true to you?
A good point. So if something looks too good to be if something looks too good to be true, then it sometimes is too good to be true. But in this case, it's not. So the reason why it looks so stable is pretty simple. You can see an example here. So that's 2017, when we had the HIM events, Harvey, Irma, and Maria. So essentially, you are looking at an event type risk and not a diffusion or volatility type risk. So standard deviation of returns or volatility is not necessarily the ideal measure for this asset class, because you can see a stable market for a long period of time, and then you'll get a jump downwards, which is why some of our results have to be taken with a grain of salt because the risk that is underlying the asset class is very rare. In insurance and reinsurance, we call it low frequency, high severity types of risks. So you have recurrence periods of the events of 1 in 50 or 1 in 20 or 1 in 100 years, depending on where the structure sits in the loss tower. And so 20 years of historical return data is okay, but we are pretty transparent in the paper that, in terms of performance measurement, it's not the whole story, right? So there are tail events that have not yet materialized in the historical return time series. So it's not a Ponzi scheme. There's another explanation, which is, it's basically a pure tail risk that you're investing in.
Yeah, I didn't suspect a Ponzi scheme, but I did wonder about completeness of the data set and survivorship bias.
Mm-hmm. Yeah, so that's a good thing. We do have all bonds that ever existed in the data set, and we do have defaulted bonds as well. So the only reason why it looks so good is that not many bonds have defaulted, because the event of a cat bond defaulting is a very, very rare event by design, right? By design. So that's the reason for it.
And one more thing here, I don't see like a dent in the thing from all those wildfires, which we've been living through here in California. So that just
there is a small one, so you have to zoom in. That the reason is that there are no pure wildfire bonds. So wildfire is a peril, as they call it, a secondary peril in reinsurance that is, has been securitized in some of those transactions, but usually together with other perils, and it's not a huge part of the market. So since we're looking here at the broad and diversified market portfolio, the impact of the wildfire losses on some of the bonds do not really make a big dent in the overall market. But if you were holding one of the bonds that were exposed to wildfires, you would have seen a loss there.
Okay, thanks.
No worries. So this makes it an attractive asset class, and this is why people have started to, a lot of pension funds and other long-term investors have started to pile in. And we do not understand a lot about the realized returns. That's why we wanted to do some research in this area. So what do we contribute in the paper? We provide the first analysis on the bond level. So that analysis I did in 2019 was on the fund level. Now we can go down to the bond level. We can really look at the cross section of cat bonds. We have a novel data set that spans virtually the whole market. So there were some transactions in the late 90s, but really singular transactions. There was not really a market. So in the early 2000s, that's basically when the market really started to exist. So we have these 20 years of data, and it's pretty comprehensive because we have every bond. There is no bond missing, so no survivorship bias. We also do have those few bonds that defaulted. There were a few events. So Katrina triggered a bond. The Tohoku earthquake in Japan, which caused the tsunami back in 2011, triggered a bond. Harvey, Irma, and Maria triggered a bond. So we do have trigger events in the data set. And so that's a good thing. So it's a very comprehensive data set we have at hand.
Question.
Yeah.
So, if a catastrophe occurs and it's triggered, when you talk about bond defaults, I thought these were designed never to default, in the sense that if a catastrophe happens, then the owners don't get their capital, but it's not a default. Yeah. It's the way the terms were written. So when you talk about default, are you meaning the same thing as a trigger event, or are you saying something else occurred?
Yeah. Now you're right. I should be very precise and accurate in what I say. So it's not a credit default event, right? So it's not a loss due to a credit default event. The loss occurs because the structure gets triggered, and a payout to the cedent or the sponsor gets triggered, which means that this capital is not going back to investors. So, let's say if I'm a bit sloppy, then I say default, but the true sort of terminology would be a trigger event on the bond, right? It's not a corporate default event. Yeah.
Great. Thank you.
No worries. It could happen that I use those interchangeably throughout the presentation, so please bear with me, but I do not mean credit default events. So what we do is we propose a 4-factor model for cat bonds based on our research results, and we find out that that model explains about 60% of the historical return variation in the market. We do have a robustness analysis where we add a few historical trigger events that we know that those triggered bonds, and that slightly increases the explanatory power. So interestingly, 60% is not very high if you compare it to factor models in the stock market. This basically shows that this asset class is significantly harder to understand and to explore in terms of what are the true drivers. So we do not know what drives the other 40%. Do we have frictions? Is this due to frictions? Is this going away as the market becomes more efficient? Or are those potential risk premiums attributable to relations between this market and other markets that we have not discovered yet? So if you remember the paper I presented last time in the fall, where we looked at the potential of stocks reacting to hurricane risk, based on the results we have in that other paper, we think a future piece could actually try to bring these two markets together, because if stocks do react to hurricane risk, there might be a clear link between these two markets that justifies a risk premium on cat bonds.
Yeah. Alex, got another question going back to your previous comment that variation may not be the world's best risk measure for this. Did you look at other risk measures to make a kind of summary here that were not variation? Because it looks like you've expressed your results in terms of variation despite
so
your previous caveat.
That's right. So my comment related to the idea of performance measurement. So if you look at a return distribution and you want to measure, let's say the risk-adjusted performance of the asset class, then calculating something like a Sharpe ratio is really not that informative, given the tail risk inherent in the bonds. What we try to do with the factor model, though, is we try to construct factors that do contain the same tail risk, like the market time series or the portfolios that we want to explain with it. So, and you see that in the when we get to that robustness check, where we do include the historical event variables, you do see that even though we're not using a value at risk or a tail value at risk measure, the classical factor model approach does work as long as the factors you construct do contain the same tail risk as the the portfolios you want to explain. So so what do we do? We run the well-known battery of asset pricing tests: portfolio sorts, Farmer Macbeth regressions, time series regressions. Some of those might look familiar to what I presented last time, but this time is a different asset class. And we do run an actual versus predicted analysis on 24 test portfolios that we put together based on bond characteristics. We randomly drew portfolios from the market, and we included the market portfolio itself to try to explain as many as possible and see what the model does in that sense. What are the main findings? So we do find that event risk is a strong predictor of future cat bond returns. So that's not so astonishing, because what you're essentially investing is event risk. So that's based on the so-called probability of first loss. That's a risk metric that is published by specialized analytics firms, catastrophe modeling firms, one of which is really close by, RMS, was founded, I think, at Stanford University, and has now been bought up by, I think, by Moody's. And there is another one, AIR and CoreLogic. So the specialized cat modelers that provide these risk metrics for every bond. So we do have them in the data, and we can actually sort and analyze based on that. What we also find is that we construct a time varying measure for the probability of first loss, because what we get from the bond prospectuses is really a constant probability of first loss that relates to the whole time horizon until maturity. We do construct a monthly time varying probability of first loss, and that accounts for seasonality, because the perils, two of the major perils that are securitized in these bonds are US hurricane risks, which have a clear season, and also European winter storm risks, which do have a clear season. And once you inject these seasonality patterns into the probability of first loss, you substantially increase the explanatory power of the model. So the market does behave according to these seasonality patterns that we have in the underlying disaster risk, in the underlying perils. We also analyze downside risk, moral hazard, deal complexity, and peak risk. And we do find none of them to be priced, right? So downside risk, we take the conditional expected loss as a measure. It's also from the perspectives. Moral hazard goes along with the idea that some of these bonds, or a lot of these bonds, actually have indemnity triggers. That means that you have almost a classical reinsurance contract embedded in the bond. So the losses that count to the trigger level of the bond are basically the losses that the sponsor or the cedent has in its own portfolio. And that means that investors have to fear, at least that's the theory in this literature, has been over an extended period of time. Investors need to be aware that if the underlying losses that count to the trigger level are in the portfolio of the sponsor itself, then the sponsor might be changing its behavior after the bond has been issued, because now you have insurance in place. So you might be relaxing your underwriting standards. So the portfolio risk profile could change during the term of the bond because the sponsor doesn't care anymore. All the risk is, the tail risk is going to be paid by capital market investors as well. Anyway, and also what changes is potentially if you have an event, then the claims handling standards might change. So you're not looking as closely onto each claim before you pay it, because the capital market investors are going to pay the bill anyway. So, but we do not find this effect, and it's been contested in the literature for a long period of time. So there's no clear empirical evidence that this effect is there. What we also find is a weak link between the broader fixed income markets and the cat bond market. So that's interesting because the industry does advocate these things as being completely uncorrelated, and we can show that they're not 100% uncorrelated. There are certain aspects of the fixed income markets that play a role with regard to realized returns, and not astonishing is that those are the two factors from the Pharma French 1993 paper. Term, basically a term premium factor, and it's a default premium factor. So this is constructed as a longer term minus a shorter term government bond yield. And this one, or in this case, in our case, it's the returns, right? The return on a longer term versus shorter term government bond yield. And this is based on a corporate bond minus a government bond return, right? So this captures a default risk premium. This captures a term premium. We already found them to be a significant driver of cat bond fund returns or ILS fund returns, and now we can show that they also drive, the cross section of cat bonds themselves. So where does this fit into the literature? As I already mentioned in the beginning, there are different strands. So the cat bond literature is not huge, but it's been growing in the last 4 to 5 years. We do have a literature on the primary market where most authors try to explain the coupon spread with econometric approaches. So the idea is you regress the coupon spread on a series of variables, for example, the characteristics of individual bonds, and you develop some kind of econometric model that can be used to predict or compute the adequate coupon spread that should be set upon issuance of a bond. Then we have secondary market papers. They try to explain the yield spread. So secondary market yields, they try to find drivers of those yield spreads. And then we have a very small literature on realized returns. So this is where we are actually positioning the paper. There are only 3 out there so far that have looked at realized returns. Particularly these guys have actually analyzed the risk and return profile of the Swiss Re Cat Bond Index. This is an attempt to look at what happens if you add these instruments to the diversified portfolio of other instruments. So it's a diversification idea. And this was the paper I mentioned before, where we looked at the NAV or return time series of investment funds specializing in this asset class. And a more recent paper where we developed an approach to market to use the information that you have, the pricing information that you have in the cat bond market, extract that information and try to use that to price other non-traded natural disaster instruments, such as industry loss warranties or classical reinsurance contracts, because there's no liquid market for those instruments. So the question is, if you are an investment fund marking your portfolio to market on a monthly basis, how should you value these illiquid positions? So that's the topic of this paper. But the paper I'm presenting today is in this area. So how can we explain the realized returns on cat bonds? What are you being compensated for when you invest in this asset class? The data set that we have comes from a large reinsurance broker. There are not so many out there, so I guess you can think, you can basically think of who that is. But yeah, I'm not. So we agreed that we're not going to mention it in the paper. We have the total market between 2001 and 2020, as I already mentioned, 757 bonds. We do have monthly prices, and we do have a lot of structural information about the bonds. So the trigger type, the underlying perils, is it a multi-peril or a single peril bond? Who is the sponsor? What is the maturity? What is the coupon frequency, et cetera, et cetera, et cetera. So a lot of information about the actual bonds that we use in the empirical analysis. One thing that we do is, before we start, we take data from Trace. So there is on Trace, there are, since 2015, cat bond trades, not all of them, but a lot of them have been reported to Trace. So Trace includes traded prices, whereas our broker sheet, actually our data includes indicative or quoted prices. And since we're running an asset pricing analysis, we wanted to see how closely these quoted prices are related to the actual traded prices. You can't use the traded prices. Why? Because the time series is much shorter, and also because it's very patchy, because you don't have a trade, on each bond on a regular basis. And so what we do is we compare these data sets to find out how reliable our indicative prices are. And we come up with a very high correlation, above 0.92 on the bond level. And so we are confident that this is good to go, right? So one sort of drawback, I have to mention that straight away, is we only see one broker. So the cat bond market is an OTC market. There are a lot of market makers and brokers involved, and we only have the pricing information from one broker. And we do know from anecdotal evidence in the industry that there tends to be some disagreement in prices every now and then. And we're just working with the industry to potentially attain another data set in which we can look at the disagreement between different brokers over time, but that's going to be a different paper. Supplementary data for other asset classes and the broader capital market. So we have the treasury yield curve. We need that to calculate the coupon streams for each bond, because what we do have is the prices and the information on the coupon frequency. So what we need to do to calculate monthly returns is we need to basically come up with the whole coupon stream for each cat bond. For that, we need the treasury yield curve and the forward curve. We then basically calculate a price and a coupon return for each of the bonds. And then we use an index methodology to basically calculate a cat bond index based on the individual coupon and price data that we do have. And we analyze the returns of that index or of different portfolios that we compute in the same fashion. And also we do have the corporate bond spreads and a property casualty rate on line index. So what are the bond characteristics that we analyze? So catastrophe event risk, I already mentioned that. It's reflected by the so-called expected loss, the probability of first loss, and the conditional expected loss. And we do adjust for seasonality, as I mentioned. Moral hazard is going to be reflected by a dummy variable that basically identifies bonds with indemnity triggers over bonds that do not have indemnity triggers. So there are other triggers out there, for example, parametric triggers, a very simple one, just measures in specific locations how fast, for example, the wind has blown in a hurricane. And once a threshold is basically surpassed, then it triggers a payout on the bond. Then we have complexity, which we define as multi-peril and multi-location bonds. So you could have a bond that only covers US hurricane risk, or you could have a bond that covers US hurricane risk, US earthquake risk, Japanese typhoon risk, and European windstorm risk. That would be multi-peril and multi-location. And the more you have in a bond, the more complex the risk is. There was some evidence in past papers that this could play a role with regard to secondary market yields. But as I already mentioned, we will find that it's not relevant for realized returns. And then we have this distinction between peak and diversifying perils, which is an important one in the cat bond market, because if you look at the market structure, you see that about 70% of the risk out there is US wind risk, and a major part of that is US hurricane risk. And so if you're an ILS only investor, you have a hard time diversifying because your portfolio will also have a large amount of US hurricane risk. And this means risks that are not US risk and are very rare, such as Turkish earthquake risk or Chinese risk, are diversifying perils in this market. And there is empirical evidence, or has been empirical evidence in the past, that shows that the issuance spreads of those bonds are significantly lower. Why? Because people tend to have a high demand for these things, because they will diversify their ILS only portfolio, which is to a large part made up of US wind risk.
So can I ask a question about
Yes.
that? So the US is dominant. Is that because the insurance and reinsurance markets are more developed, or the cat bond market for US risk is more, is further along? Because presumably there are substantial risks in China from typhoons and earthquakes.
Yeah.
So what is it? Is it the development of the market that affects that, or what?
Mm-hmm. So it's two things. So the size of the primary insurance market and reinsurance market in the US is the largest insurance market in the world. So a lot of this risk, or virtually all of it in the past, and now still a lot, is coming through the insurance and reinsurance sector. So they take on the risk from households and companies first, and then they have it on their balance sheet, and then will securitize parts of those risks out and pass it on to capital market investors. So if you have a large primary insurance market, it's natural that there's more going on in the retrocession or reinsurance market, or in the securitization market. China has still a relatively low insurance penetration compared to Western countries. It's growing fast, but it's not there yet. So that's one reason. And the other reason is that in the US, you find a lot of highly valuable structures in areas where that are really exposed to natural disasters. So if you take the Bay Area, for example, where you guys are based, it's one of the the real estate there is probably among the most expensive real estate in the world, and it's right there. It's sitting on a fault line, right? So if there is an earthquake, there will be massive losses, and so that's another reason, because in the US you do tend to have a lot of value sitting in places where things can be uncomfortable when you have a natural disaster. So that's a combination also in this in this market. It's not just about the natural disaster. The natural disaster needs to occur in a region, in an area where you do have a lot of insured stuff, right? Because it's insurance losses that are relevant for the payout. Does that answer your question?
Yeah, thank you.
Perfect. Okay, so so these are the relevant cross-sectional characteristics that we're going to analyze with regard to their impact on the returns. Now, I mentioned that we need to translate the constant probability of first losses into, so the event risk, if you want, into a time-varying one. I'm not going to be too specific here, but what we do is we apply a very simple reduced form model. And we basically take the PFL figure we get from the bond prospectus, or that we have in our data set, and we use this reduced form model to extract an implied lambda, an implied Poisson intensity rate. or hazard rate. And then we take this hazard rate that we extracted, and this is an annual one. So what we do is we divide it by 12 to turn it into a monthly one, because we're going to run our analysis on a monthly basis. We also have monthly return time series. So we want to be able to do a monthly sorting and a monthly rebalancing of the factor portfolio. So we translate this annual hazard rate into a monthly hazard rate. And the second and more important step is this one. We then translate the monthly hazard rate, the annual hazard rate also into a time-varying monthly one. And the way we do this is very simple. We have these two distributions from AIR. AIR is one of the large modeling firms in this area, and they have, based on their natural disaster risk models, they have come up with simulated distributions of hurricane events and European winter storm events across the year on a monthly basis. So you can clearly see here where the hurricane season kicks in, right? So it starts in June and it ends in November. That's the Atlantic hurricane season in the US. You can see that it peaks in September. So in these months here, the probability of experiencing a trigger event is much, much higher than outside the season where it's virtually zero. So a constant monthly PFL throughout the year does not really reflect the true nature of the risk. The risk is highly seasonal. And what we do is we just take these distributions here that we call gamma, and we use them to distribute the hazard rate across the year, so that outside the season you get a zero hazard rate, and in the season, in the months of the season, the hazard rate will be higher. And then we reinsert the hazard rate again into this simple reduced form model to get a probability of first loss that is now time varying according to the seasonal pattern. So we inject, if you want, we inject the seasonal pattern for these two types of seasonal perils into the probability of first loss, because that's going to be our main event risk variable. And then we do calculate something that we call the seasonality amplitude factor by dividing the probability of first loss on a seasonal basis through the constant probability of first loss. So the idea is here that this is a factor that can be it can be 0 or it can be larger than 1. So it's 1 when the probability of first loss based on a time varying basis is the same as the constant one, and it increases above 1 during the season where the time varying probability increases to a much higher level, and then it comes back down outside the season. So what we're looking at here is we can compare different perils according to the amplitude. So how far does it move away from the constant probability? And we'll see that that makes a difference. So bonds that have a lesser amplitude, bonds for which the scaling difference, if you want, between the constant and the time varying probability is not as large, do not experience the same returns as bonds for which this is larger. So the larger it is, the higher the compensation for the investor. In the second step, we also need to make sure that we can cover multi-peril bonds. So this is an issue here because a lot of bonds do have a whole mixture of perils, not just US hurricane and European wind, but a lot of different other things in there, right? California quake, Japanese typhoon, and so forth. So in the interest of time, I'm just going to go over this a little more quickly. But what we do is we regress the yield spreads of each bond on the expected loss figures that we have for the US and European windstorm perils. So basically these two. So we do have expected losses for these two. And then what we do is we calculate what we call peril shares of each of those two for each category of bonds. So we create 6 categories of seasonal bonds and 1/7 category, which does include all non-seasonal bonds. So pure earthquake risk. Earthquake risk is not seasonal. So that's category number 7. And what we like to do is essentially make sure that we are able to capture the seasonality in each of those 6 categories correctly, right? Because a bond that is not only exposed to the US season, but maybe to the US season and to the European season will have a different seasonality profile. It's not the pure hurricane risk profile that you see here, it's a mixture of both, right? And depending on how much of these risks are embedded in the bond, it can actually vary. And we do have, I can show you this on the next slide. We do have this seasonality factor for each and the probability of first loss, the time vary one for each of those 6 categories, because they might look differently. So here you just see the pure single peril US hurricane, which peaks in September and is between June and November, and you see the European season. But for all these multi-peril bonds, you will have some mixture of the two, depending on the weightings that we estimate through this methodology. Okay, so that's the idea. We need to make sure that each category of perils is treated according to the combination of risk that you have in the bond. Then we start with sortings. So univariate sorting according to bond characteristics. We sort according to the expected loss, to the constant probability of first loss, conditional expected loss, our seasonality amplitude factor. We do sort according to the yield. So that's a little bit of a side experiment we do. I'm not going to go into further details here. And we do sort according to a lot of binary variables. So we have a dummy that differentiates, as I mentioned already, indemnity triggers from non-indemnity triggers. This is multi-peril bonds versus single peril bonds. This is multi-location bonds versus single location bonds. This is hurricane versus non-hurricane risk. And this is US risk versus non-US risk. And what we do is on a monthly basis, we create, in this case here, 5 portfolios, and for the binary variables, 2 portfolios that we sort every month according to these variables, right? So the bonds with the highest expected loss will be in portfolio 5. The bonds with the lowest expected loss will be in portfolio 1. And we do that in every month that we have in the time series. And then we look at the average returns of the time series of these quintile portfolios, and we do calculate the difference between the first and the last and look whether this difference is significant. In other words, saying that, is there an excess return over our time horizon that we analyze in the paper for bonds that have a high expected loss versus bonds that do have a low expected loss? And what you can see here is that that's what we find in these univariate sorts. So, and that's what you would expect, right? Bonds that have a higher event risk should pay a higher expected return to investors. Also, if you decompose it, so expected loss is the product of the probability of first loss and the conditional expected loss. So the interesting thing is, if you basically dissect the expected loss into its components, you see that the driver of this effect is actually the event probability and not so much the conditional expected loss. So this is the loss given you experience a trigger event. How much are you going to lose on the bond? So in terms of, if you want to compare it to credit risk metrics, this would be the probability of default, and this would be the loss given default. So that's the analogy in the credit markets. And we do see differences, for a lot of these other factors, but this is only a univariate analysis, right? So now we want to go further with multivariate analyses, and we do conduct Farmer-Macbeth regressions. So the way this works is, in each month of the time series, you run a cross-sectional regression of next month's return on this month's cross-section of bonds and their characteristics. And then in the end, what you report or what you calculate is the average result for all of those cross-sectional regressions. So essentially what we're running here is 240 cross-sectional regressions. So 20 years with 12 months each year. So we have 240 monthly cross-sectional regressions, and we do report the Farmer-Macbeth statistics. And what we see here is we do this first for the event risk variables. So we do see that in the Farmer-Macbeth approach, we also have a significant impact of the expected loss. We also have a significant impact of the probability of first loss, but we do not have a significant impact of the conditional expected loss. So that confirms the result here from this slide from the univariate sorting in a multivariate context. So essentially what we conclude is we can drop expected loss and conditional expected loss, and we will work with a probability of first loss going forward, which is, by the way, consistent with some of those other papers, very recent papers that I've shown on the literature review. It's starting to emerge as a fact that the actual risk that is being priced in the cat bond market is the probability of the trigger event occurring and not the conditional expected loss given you have a trigger event. So we continue only with the probability of first loss. And we then throw in all these binary variables and our seasonality factor to see in a multivariate approach, how do we do? We also control for maturity of the bond, and we control for the size, the issuance size of the bond. You can see that in none of the regressions, these variables are significant, but we still do control for them. So we have the probability of first loss is going to be in every regression. Then we subsequently add one of the other factors, and at the bottom, so that's the most important line here, we do have the comprehensive analysis with the probability of first loss, the seasonality factor, and all these other ones. And you can see that in the multivariate approach, a lot of the stuff that we found in the univariate approach disappears. The reason being that, you know, a lot of the hurricane bonds are also high risk bonds and are obviously also highly seasonal bonds. So you're now soaking up the explanatory power in these factors. You do not need the crude differentiation hurricane, non-hurricane anymore, because the seasonality will capture a lot of this. And obviously a lot of the hurricane bonds are also, so we see that in the data, are also tend to be the higher risk bonds. So tend to have a higher probability of first loss in the first place. That has to do with where you place the structure in the loss tower. So if the trigger level is lower, obviously, then losses after the event do not need to mount as high up to actually trigger the bond. So if the structure, if the layer of that structure is lower down, then the probability of first loss will be higher, and hurricane bonds tend to be sitting a little lower in the loss tower than others, for example, earthquake bonds. So the only thing that is slightly significant still is the indemnity trigger. But if at all, it's not a markup or an excess return you collect for investing in indemnity bonds. If at all, it's a lower return that you get. So this could be a hint that if there is moral hazard going on, then it should actually be priced ex ante. It seems like, yeah, as we're not sure about this. We don't see this as strong evidence for moral hazard. We're actually not really carrying this over to the further analysis. What we do carry over are these two, right? The probability of first loss and the seasonality factor. And we do now convert these things to factor portfolios, zero investment portfolios, in a sense that, just going back to show what we do, the factor portfolios are going to be return time series of 5 minus 1. So the difference here, the zero investment portfolio, and we do that here for the constant probability of first loss, for the seasonality adjustment factor, and for the time varying probability of first loss. And then we add, further at the back, we add the term and depth factors I mentioned in the beginning from pharma and French. And if you look at the model, the constant probability of first loss, oh, by the way, what we do here, this is no longer pharma Macbeth. This is a regression of the time series, the excess return time series of the market portfolio, the cat bond market portfolio, and we regress that on these various factors. So essentially, we do have a factor model, and we use a time series regression to see how much of the time series, historical time series variation in excess returns is explained by this factor model. And the first and simplest is a one factor model that only has the constant probability of first loss. Then we do add the seasonality adjustment factor. We do add the seasonally varying probability of first loss factor and term and depth subsequently. And what you see is, once you add PFLS and also the seasonality factor, this constant probability of first loss does no longer play a role. So essentially, all the explanatory power is contributed by the seasonality factors and not by the constant probability of first loss. So there's only a very small fraction of bonds that is non-seasonal, and those are the earthquake bonds, and all other bonds in the market, the vast majority are seasonal bonds. And so obviously, if you account for the seasonality, there's not much left you explain with a constant probability of first loss. So this shows how important it is, and this also goes along with anecdotal evidence we have from ILS investors, from traders actually. This shows how important it is to account for the season. And then if you look at the last model, which includes these two new factors from our work, and then term and depth from the Pharma and Fringe 1993 model, you see that they are also significant. So that means there is a little bit of a link between the broader fixed income markets and the cat bond market. We go up to about 60% of explained variance, even if you look at the, if you adjust the R squared for the number of variables. But we are left with a constant, that's the alpha, if you want, the abnormal return. We cannot explain without factors of 0.16% per month. So this is something I can already say that will be left for future research. But what we do is we go on with this model and benchmark it. We do benchmark it with the Pharma Fringe 1993 model and the Pharma Fringe 2015 model, which you can see here in columns 2 and 3. So this is just a repetition. This first column is just a repetition of what I've shown you on the previous slide for comparison reasons. Then we run the regression of the excess return time series of the cat bond market on this Pharma Fringe 1993 model. We do see, interestingly, that only the market, this is the stock market factor, right? That's the Pharma Fringe stock market factor. You can see here the market factor, S&P, HML, and then the new 2015 model includes the profitability and investment factors, and the old 1993 model includes these two fixed income factors. Only the stock market factor is significant. If you go to the 2015 one, the stock market factor is significant, and there's a tiny little bit of significance in RMW. Now, interestingly, if you think about the paper I presented last time, where we looked at hurricane risk, which is seasonal catastrophe event risk, and we suspected there might be something priced in the stock market. Now we do see that the broad stock market does explain a little bit of the return variation in the cat bond market. So this is evidence that points in the same direction. And the next step, what we were planning to do is take the factor from that other paper that I presented back then, which is more tailored. It's a stock market factor that is more tailored towards hurricane risk, and see whether that increases the explanatory power if you add it to a model like this. So I do think, based on the evidence we have in the other paper and based on this evidence, that cat bonds are actually not completely uncorrelated to the broader stock market. There seems to be traces of a relation, a link between these two markets hidden here in the market factor. And with the other factor that we constructed in the other paper, we're hoping to carve that out to actually dig out what's hidden in the market factor here. Now, if you look at the last column, where we just take all factors into account at the same time, you see the Pharma Fringe factors basically go away, right? They're not significant. Stock market, again, stays significant. It's a very good sign for future work to provide evidence of that link between cat bond and stock markets. And, the factors from other paper, they obviously also still work. We then benchmark it in terms of actual versus predicted average excess returns. So the way this works is you have the actual average monthly return of 24 test portfolios on the y-axis, and we have the predicted expected excess return, which is predicted by our model, and these are different ones. This is a simple one, just including the probability of first loss constant factor. And this is our 4-factor model that I've shown you, this one, right? And so what you would like to see is you would like to align these test portfolios, or see these test portfolios align along the 45-degree line. And the less they align, the worse is the fit. And we also calculate the RMSE for these models. If you look at the cat bond models, this one is sort of okay-ish, but it still has an RMSE of 0.259. If you look at the 4-factor cat bond model, it shifts this whole cloud of test portfolios much closer to the 45-degree line, and the RMSE significantly decreases. And if you compare that to the Pharma French 1993 5-factor model, so that's the classical 3-factor model plus term and death, and the 2015 5-factor model, then they do not explain this asset class. So there is not much in these models that can pick up the actual return variation that we do have here. So we think we're getting a lot closer to what drives this market. And obviously you can already see seasonality is a major part. So if you understand the seasonal patterns, the seasonal variation of the underlying natural disaster risk over time, this market gets highly predictable in terms of the non-event variation. So that goes back to Lisa's question from the beginning. So this is mostly non-event variation, right? So if we do have events and we do have a robustness check on that, then the explanatory power is, it doesn't work as well, or the other way around. If we add these event dummies, we can increase the explanatory power further. So just a quick question, how long do I have? I'm just looking at the clock. It's
Yeah, so the seminar goes formally another 24 minutes. You're
okay, so I'm good.
most welcome to the time. I have a question though.
Yes.
I don't know what more material you have. Do you use climate models?
I haven't yet.
In your forecasting?
In this paper, you mean?
Well, and even wherever you want to answer.
Yeah, so that I think this is really interesting because climate models would induce let's say an ultra long-term perspective into the equation, because what you use in the cat bond market is these modeled loss distribution provided by catastrophe modeling firms, but they do model them. I think they have started to actually inject climate change variables into their catastrophe models. So that obviously only plays a role for meteorological and hydrological perils, so or atmospheric perils, if you want, hurricanes, floods, wildfires, and things like that. Not for earthquakes. But they do include that in, and that where that actually shows up is in the expected loss figures. So in these expected loss figures and probability of first loss figures we do have in the data, and that's based on the analysis of those cat modeling firms. So essentially what I'm saying is they are already using this and injecting it into these metrics, which we then take and use for our analysis. But yeah, it would be interesting. I mean, if you have a recommendation with regard to a climate risk model, I think this is something that has been on my mind for a while. Is can we actually use this market and the pricing that goes on in this market as a laboratory to infer something about how investors assess the climate risk that is basically driving or going to drive some of those events going forward.
Yeah, happy to talk more about that. Obviously, future pioneering sort of effort, but it seems kind of natural, right? I mean, 5 years ago, it didn't occur to me living here in California that wildfires were going to be a problem every fall, and now we were very surprised they weren't this previous fall when we had different problems, but we didn't have that one. So,
absolutely, yeah, this is going to be a major variable also in this market, and there's a lot of discussion going on as to how these modeling firms account for it. So this is a little bit of a problem that these are proprietary models that they use. So they call themselves also model vendors. So you can actually buy the software and use the model, but you don't know exactly what they do, which is also why the different modeling firms can come to a different assessment of the expected loss of a transaction, because they do use different models, right? That makes it very interesting here. Okay, so yeah, coming back to so I would say, these natural disaster risk models, they're very, very interesting because they include a very broad spectrum of, different sciences, right? They include atmospheric sciences or seismic, seismology and things like that. They do include engineering know-how because you need to see how an event like a hurricane actually impacts a structure like a house or like a factory. So you need to actually translate the actual parameter values in terms of wind speed and quake strength into physical damages to a structure. And then you still need to translate these physical damages to a structure into financial losses, right? Insured losses. And what we see in the expected loss figures is essentially the end of the chain. That's the insured losses that they have modeled. Yeah, so we are only using these relatively traditional financial economics models. I think the natural catastrophe models are certainly, more interesting because they're a broad mixture of different science approaches. But that sort of goes a bit away from the core. So what I also wanted to say with the remaining minutes, we do have one sort of issue still in our model. That is, we have constructed, as you remember, the factors as long short portfolios or as zero investment portfolios, so 5 minus 1.
Mhm.
And that's a pretty common approach in the stock market and also in corporate bond market research. The problem here is that the cat bond market does not allow for short selling of this risk in any shape or form. So not through securities lending and not through derivatives. There are types of derivatives like industry loss warranties or cat swaps that you can use to take a short exposure on the risk, but not exactly the same risk that you have in your long portfolio in the cat bonds. So in terms of a trading strategy, it's actually not really possible to construct these long short factors, which is why we do run a robustness analysis if we take only the long portfolios, right? Not the 5 minus 1, but only portfolio 5 or 4 or 3 or 2 or 1. So these are the quintile portfolios as the factors.
Is the inability to short these regulatory, or is it just the market has not developed for the latter?
Yeah, the latter.
So there's
yeah.
no law prohibiting
Exactly.
shorting these securities. Okay.
Yeah. And I think, as the asset class matures further and the market grows, there will probably be, we would expect that something occurs where you can actually start, run securities lending or do short this. But I think we're still a bit away from that stage of the market. You can compare this to the asset-backed securities or credit structured credit markets probably in the 90s, before the markets took off significantly and a lot of different ways of shorting risk, for example, through default swaps and things emerged. So this is still early years, I would say, and yeah, I'm expecting that at some point this should change. Yeah. Okay, so if we run this with long only factors, so we don't take the 5 minus 1, the difference portfolio, we just take the portfolio 5 or 4 or 3 or whatever. And then you see that, so this is the model that I already showed you. And these are the long only factors. And the interesting thing is the long only factor, if you only use the riskiest portfolios as factors, comes up with a better adjusted R squared than the long short portfolio. And the reason is, you quickly see that every other portfolio, so the 4 riskiest portfolios, if you use them as long factors, they do quite good job in explaining the excess returns on the market portfolio. The only portfolio that doesn't do such a good job is the lowest risk portfolio, in this case, portfolio number 1, right? So if we use that as a factor, it doesn't do such a good job. And since this here is 5 minus 1, you are actually losing explanatory power compared to the situation when you only use portfolio 5 as a factor. And why is that? So we asking ourselves, how can that be, right? And the answer lies in the construction of the portfolios. So what you see here is the average portfolio weight of different perils. Remember the 6 cat bond categories? We here added the 7th, which is non-seasonal. So now we have 7 categories of cat bonds, and we show how much of these individual risk categories are included in each of the portfolios in an average month, right? So this is the average weight of these different perils in the portfolio in January, the average weight in February. So if you take all Februaries in our time series and you take the average across them. And now, first of all, what you see if you look at portfolio 5, which is the riskiest one, you can see that it substantially increases, and these are the red shaded area, substantially increases the allocation to US wind, particularly hurricane risk during the season. Why? Because exactly during the season, these bonds become the riskiest. So our time varying probability of first loss is highest. So all of these bonds slide into portfolio 5, right? This is the way we sort it. Portfolio 5 includes the bonds with the highest probability of first loss. So in the season, they all slide in here, and outside the season, you have the portfolio filled up with other things such as earthquake risk or European perils. And you can see that portfolio 1 does do the exact opposite. So outside the season, this lower risk portfolio stocks up massively on US wind risk, and inside the US wind season, you have very little US wind risk in this portfolio 1. Now, it tends to be the case that the market itself, the market portfolio, which we use as the dependent variable in these time series regressions here, the market itself is substantially driven by the seasonal risk over time. So this pattern here much more closely reflects the overall pattern that is going on, the rotation through the perils, through the seasons that is going on the market portfolio than this pattern. So this is, if you want, is basically opposite to the market portfolio. And this one is very close to the market portfolio. So if you are combining these 5 minus 1, you are washing out, variation that you need to explain the market portfolio. And I haven't shown the compositions of these other portfolios 4, 3, 2, but you can see here that they also have relatively high adjusted R-squareds. So they do a good job in explaining the market, the variation, the time series variation in the returns of the market portfolio, because they are also more closely related to this pattern than this pattern.
Yeah.
So this is another, yeah.
Yeah, just as a methodological comment, I love this idea of explaining a portfolio, a long-only portfolio with long-only factors. Mm-hmm. Throughout finance, long-only portfolios are explained with long-short factors, and it leads to every kind of misspecification, correlations between idiosyncratic return, and, and I mean, it just makes a mess. And this is wonderful.
Yeah, and this is a very good comment, because one thing that I also wanted to point out here, and this directly relates to what you just said, Lisa, is if you look at this here, you can see that a lot of them are like on a parallel shifted line above the 45-degree line. And if you look at these results here, you can see that the alpha that our long-short portfolio leaves goes away if I use the long-only portfolios. And so what I also believe is exactly what you mentioned, just that throughout finance, sometimes mistakes happen if we use long-short portfolios. In this case, it seems to be the same, because if we use the long-only portfolios, the alpha goes away. And this is like shifting this in parallel to the 45-degree line. And our hypothesis is, and we still have to look a little deeper into that, is that what we see as an alpha here is a generic excess return of the whole asset class compared to other asset classes out there. And if you run a long-short portfolio, you cancel this out, and so that this excess return, this abnormal return, is included in the market, but not in our factor. Why? Because in the long-short portfolio, we have canceled it out, right? And it's still in the market. So we cannot explain with this factor, we can't explain this in the market. If you use the long-only, then this peril-specific abnormal return is included both in your dependent and in your independent variable, and therefore the independent variable can explain, what we saw as an abnormal return here. So yeah. Sorry, but
Great.
yeah, I think you wanted to add a second sentence, and I was so excited about your comment that I just started
I just,
talking.
it was just, it's such a basic good idea. I applaud it, and I'm happy to see it. And
Cool.
I'm so used to seeing misattributions
Mhm.
of long only portfolios to long short factors, which
Cool.
it's completely crazy. So this was very sane, and I thank you for it.
Cool. Thanks a lot. Yeah, that's good. So the way we stumble across this is we just, we wanted to find out what actually happens if you use a realistic portfolio, in the sense that this is actually a trading strategy, right? This cannot be implemented in reality, and all of a sudden you find an interesting aspect about your data. So just looking at the clock, I think I should sort of come to the home stretch. We do run a couple of other robustness checks. I think they're mostly not so interesting. I mean, what we show here is that the amount of explained variance is quite stable. If you look at different time periods, it drops a little bit here during the financial crisis. You can see this here. So these are the years that include the financial crisis. You can also see, interestingly, that from pre-financial crisis to financial crisis, the effect or the link to the corporate credit markets is much more strongly reflected here. And there are a few structural reasons. So a lot of cat bonds at the time were including a so-called total return swap. Lehman Brothers was a swap counterparty and defaulted at the time. So you had technical defaults in 4 cat bonds that were not due to trigger risk, which is why Bob's comment in the beginning was so important. So here we saw a few defaults of cat bonds, because the collateral was impaired and the total return swap counterparty was not able to stand up to its guarantee. So you had a technical default, not because of a natural disaster. And this is what you see here, a stronger impact of the corporate credit markets. And I think that's worth highlighting. We also add these downside scenarios. As I mentioned, Katrina, this is the Lehman default, Tohoku earthquake, Irma and Maria in 2017, the California wildfires that we talked about, and the COVID-19. So we happen to have the COVID-19, that V-shaped return pattern did not so much materialize in the cat bond market, only very little. The reason is that in times when liquidity is imperative, this is an asset class that still holds its value. So a lot of investors disinvest from this asset class to recover capital that they can use to bolster their portfolios, which has lost value in other asset classes. So which sometimes why you might see a slight downside, development in crisis scenarios. Interesting part is they're all significant. So we do collect downward spikes in the returns with these dummy variables here. But if you add our 4 factors, you can see that the coefficients on these dummy variables do decrease. They still remain significant in most cases, but they do decrease, right? So this means that the factors cannot explain the full sort of crash that you experience when you have a Tohoku style event, but they do explain some part of it. And by definition, these are really unpredictable events that materialized, and so you will never be able to construct a factor that perfectly matches the behavior of your test portfolios in these individual event scenarios. But this is interesting. It also, if you add the event scenarios, the performance does look good. What this tells us is the actual unexplained variance, if we take into account unexplainable events, is probably not 40%, but rather 30%. So it's a little less that we still have to explain going forward. Okay, so that brings me to the last slide. I think I have 2 more minutes, right? So what we do think is this is a good first attempt to have a factor model for cat bonds. What this is useful for is the benchmarking of ILS asset managers, because what they do is, they say, look, we outperform any benchmark you can give us, because if you use a capital asset pricing model or a pharma French model, they look gigantic. Everything is an alpha return, right? But it's not, because you need the correct factors. So if you benchmark ILS fund manager against a model like that, then their alpha will be significantly lower. And that's okay, because what they're essentially doing is, if you're implementing a buy and hold strategy in this asset class, you should not see a large alpha, right? So that buy and hold approach, or even just a seasonal rotation through a very simple seasonal rotation through the perils, is now reflected in the factor model. And you can calculate the cost of capital for these kinds of firms. We still have this unexplained alpha. And we do believe that this comes from systematic factors, links to other markets. As I mentioned, I think a very hot lead on that is the combination of our hurricane risk factor from the stock market that I presented in the fall, and this asset class. So hopefully a little bit of this unexplained alpha will be attributable to, you know, the fact that the underlying disaster risk is actually influencing both certain firms and their stocks in the stock market and cat bonds. So they do both react to the underlying natural disaster risk. So there is a systematic, so this would be proof or evidence for a systematic risk. The rest could be frictions, and we haven't looked into that yet, but there are models that, you know, could be used. That's also future research. Liquidity risk is something that we want to look at going forward. So we do have a first attempt in the paper, but the data is just not good enough. But it's pretty likely that a little bit of this unexplained return is also liquidity risk, because the asset class is less liquid than the corporate bond market, is less liquid than the stock market. So you would expect an illiquidity premium to be part of the return as well. And yeah, so I think I took this and already said it here. So this is what we would like to explore going forward. The paper here that I presented is exclusively looking at the cross section inside the cat bond market, but the really interesting part will be, how does this market link up with other markets, and can we use or construct factors in other markets like in the stock market that then take away more of this unexplained return. And that was it. So I'm not sure. Do we have 1 or 2 minutes for questions, in case you guys have questions?
Yeah, we've had quite a few throughout. Are there any more questions? If not, well, thank our speaker. That was really great, Alex, as always, and hope we can connect up with Jeff again on some of this work. I know he's interested. And want to thank you so much, especially for staying up late in Switzerland to talk to us, and mention that next week we are going to have an very opposite of the web lets us have speakers from around the world, which is great, but next week we're going to be trying our first in-person seminar in 2 years. Kathleen Hassels will be talking to us. So I hope to see you then. And everyone have a really great week. That was a wonderful talk, Alex. Thanks so much.
Thank you. Thanks a lot for having me. It was great to be able to you know, present in your seminar again. And yeah, I wish you guys a great rest of the week and a great next seminar. And let's stay in touch. Would be cool.
To stay in touch.
Thanks everyone. Bye and good night.